Finding winning stocks can feel, well, pretty overwhelming. Do you buy and hold for the long haul, or do you try to ride the hot hand? Turns out there are a few key frameworks that really help explain how market winners actually emerge. So in this explainer, we're going to break down 3 of the most powerful ones. Let's dive right in. Okay, I know it sounds like the beginning of a really weird joke, right? But the answer, and I promise there is one, gets right to the heart of how value is created, how it's captured, and how it's sometimes just plain dictated in today's market. Stick with me, and you'll see exactly how these 3 seemingly random things are all deeply connected. All right, first up, we have to start with the legend himself, Warren Buffett. Now, his philosophy isn't about chasing latest trend. Nope. It's all about finding businesses that have a deep, almost unfair advantage. He likes to call it a consumer monopoly, but you and I probably know it better as an economic moat. To figure this out, Buffett has this incredibly simple but really powerful test. He just asks, could you compete with this business if I gave you billions of dollars and the 5 best managers on the planet? If the answer is no, well, then you've probably found a company with a serious, sustainable advantage. It's a business protected from competition, just like a castle is protected by its moat. So what is this moat, really? Well, think of it as a protective barrier. It could be a brand name everyone knows and loves, like Coca-Cola, or it could be a critical service that other businesses literally cannot function without. That moat is what allows a company to fight off competitors and just keep earning those high profits year after year after year. And what does one of these protected castles look like on the inside? Well, Buffett's excellent businesses are pretty much financial fortresses. They've got predictable earnings, they carry very little debt, and, this is key, they have the power to raise prices without scaring off all their customers. Plus, they don't have to spend a fortune on new equipment all the time, which means more cash flows right back to the people who own it. Okay, let's drill down and get a bit more specific. One of the absolute strongest moats out there is what Buffett calls a toll bridge. Basically, a business that provides a service other people have to use. And these aren't just some old-timey idea. They exist right now, today, in a very modern form. These 6 traits right here, this is the blueprint for an incredible profit machine. It costs a fortune to build in the first place, which creates this massive barrier to entry. Then your customers have almost nowhere else to go, and you know they're going to need your service for a long, long time. And the best part? Once it's all set up, each new customer costs you almost nothing to serve, which gives the owner just incredible pricing power. So, what does a modern toll bridge actually look like? Well, forget concrete and steel. Think software. A great example is a company called Dye & Durham. They provide the essential software that links up land registries and banks to get property transfers done. It's like the hidden digital plumbing for almost every real estate deal. And when you look closely, the parallels to a classic toll bridge are just stunning. Instead of pouring concrete, Dye & Durham spent a fortune integrating their software with governments and banks. They totally dominate their market with about an 80% share. And just like a real bridge, demand is a certainty. People are always going to be buying and selling houses. And the result of all that? Insane pricing power. They famously hiked their prices over 1,000%. Okay, so that's the whole moat philosophy. Find a fantastic business and just hang on for the ride. But there's a completely different way to think about this. It's a school of thought that says, don't look for value, look for momentum. The idea isn't to find the winners, it's just to ride them. So on one side, you've got this slow, patient gardening approach to growing value. And on the other, you have this explosive, rapid, almost chaotic price action. We're talking about 2 totally different ways of seeing the world and the market. This approach is often called momentum investing. And the core idea isn't to buy some cheap, forgotten stock and hope it goes up. No way. It's to buy the stocks that are already leading the market, the ones that are hitting new highs and have all the attention. There's a quote that just nails this entire mindset. The strong get stronger and the weak get weaker. In the market, just like in a lot of things, leadership tends to be a self-fulfilling prophecy. The winning stocks attract more money, which pushes their prices higher, which, you guessed it, attracts even more money. Meanwhile, the laggards just get left in the dust. And get this, there's a wild statistic that backs this all up. Someone studied the biggest stock market winners over the years and found that on average, their relative strength rank was an 87. What does that mean? It means they were already outperforming 87% of all other stocks before they made their biggest, most explosive move. They weren't some hidden gem you had to dig for. They were proven leaders who were just getting warmed up. So we've talked about moats, we've talked about momentum, but there is a third massive force shaping the market today, one that can make or break a stock, honestly, regardless of its business quality or its price chart. I'm talking about the rise of passive investing and the incredible power of the people who run the big indexes. Over the last couple of decades, literally trillions of dollars have moved away from active fund managers and into passive funds. You know, the ones that just buy whatever is in an index like the S&P 500. This has had a huge unintended consequence. The committees that decide which stocks get into those indexes now have an unbelievable amount of influence over the entire market. And that influence actually has a name. It's called the index effect. See, when a company gets added to a major index, every single fund that tracks that index is forced to go out and buy its stock. This creates this huge artificial wave of buying that can send the price soaring, and it might have absolutely nothing to do with how the company is actually performing. Just to give you a sense of the scale of this power, think about this. A few years ago, the index providers decided to create a brand new real estate sector. Just by doing that, a simple administrative change, an estimated $100 times billion was automatically reallocated into those specific stocks. These providers have, in effect, become the market's new kingmakers. So we have moats, we have momentum, and we have this giant machine of passive investing. How in the world do you put these pieces together? Let's try to build a modern playbook for understanding how today's market really works. Here it is, really all laid out. You can think of it as three different lenses to view the market. First, there's the moat lens, where you're hunting for those untouchable toll bridge businesses. Then you've got the momentum lens, where you're only focused on the proven market leaders that are already winning the race. And finally, you have the machine lens, where you're watching the index providers to anticipate where trillions of passive dollars might be forced to flow next. And that brings us right back to our original question, but with a fascinating twist. The old-school Buffett-style investor believes that great companies are found. The fast-moving momentum trader believes that great companies are followed. But now, with the incredible rise of passive investing, we have to ask a new question. Are some of today's biggest winners simply chosen? Definitely something to think about.